We're looking here at question 1 in chapter 5. It's on page 110 of the Advanced Taxation Manual. So it's a rental income calculation. It's asking us to calculate Johnson's assessable rental income for 2017. And we take a read of it. 2 rental properties, property 1, property 2. Both are residential, which means as long as you're registered with the Residency Tenancy Board, you're allowed to claim 80% of the mortgage interest as an allowable rental expense. So we look at property 1 first and then look at property 2. So the detail on property 1 are income 19,000, and then we've got our expenses. And he registered property 1 with the RTB, so this expense 10,900 will be reduced down to 80% of that figure. And the other expenses look fine: insurance, cleaning, repairs, light and heat. They're all allowable expenses. There's nothing capital in nature there. So when you're doing this, we look at property 1. There's the income, and we just take away the expenses, and the mortgage interest gets reduced down to 80%, and that's our profit. And when you have more than one rental property, as we do in this instance, what you do is you look at each individual property separately, like we do here with property 1, work out the profit, and then add whatever the profit or loss is on the other properties together to get the total. So we've looked at property 1, and we've got 7,349 profit, and now we go to property 2. Property 2 is a bit trickier. So everything on the face of it looks fine. It's the same thing. Restrict mortgage interest by 80%. The tenants in property 2 left at the end of May, and they'd been paying rent of 541. But when they left, the rent for April and May were unpaid. So the rules for rental income is it's taxed under Schedule D Case 5. Here is a computation with our income less expenses, less any capital allowances and loss brought forward. But in relation to income, it's on what's earned. So it explains there, if for some reason a tenant was late paying in 2017 and didn't pay until 18, well then you'd still include it in 2017's figure. However, if a tenant fails to pay rent and it cannot be collected, then you can exclude that rent from the calculation. So if it becomes a bad debt, if the landlord is never going to get the money back. And that's what's happening in this instance. We have Johnson has been unable to recover this amount. So he has 5 months rent, of which he only got 3. So January, February, March. So when we look at property 2, his income is the first 3 months at 1623, 541 by 3. And then lease B, which is the second lease. We got new tenants from September, October, November, December, 4 months at 1546, 6184. So that's the income there, 7807. And then we take away the expenses. And the mortgage interest is here. And this is important, this bit here, where the tenancy to the end of May was registered. So the first lease A was registered, so he could claim the mortgage interest for that. He forgot to register the tenancy for the second lease. And here are the leases, and I've just written it there just so we know. So that's his interest for the month. His interest for the year was 5080 for 12 months. He's registered for 5 months with the RTB up to the end of May. That's 5 months, January to May. So 5/12 of this is allowable. So 512 by 5080 is allowable interest, and then because it's residential, it gets reduced down to 80% of the figure. And then the rest of the expenses get taken away, and there's no workings or anything to do with them. They're all straightforward. The insurance, the cleaning, repairs, etc. are there. And the profit works out 170, and that profit gets brought up then to the overall calculation. So then we're just left with property 3. So on the 1st of April, new property, and then you let the new property from 1st of August. So if you see a property let for the first time, which it is here, you have to think of pre-letting expenses. And in relation to pre-letting expenses, they're here on page 85. If you read this, expenses incurred before the property is rented out for the first time, not allowed, except for letting fees, legal fees, and advertising. And this is the big one. Interest paid on borrowings before the first letting will not be allowable. Oftentimes, insurance and interest are the ones. It needs to tell you the insurance was paid from. If it tells you insurance was paid before it was let out, then you would disallow the pre-letting part of the insurance. The same with interest. And then we've got rental income and a premium. So the rental income is easy, 1,600. I let it from August, so August, September, October, November, December. So 5 months at 1,600 is 8,000. And then there's a premium, and that's here. Premiums on short leases. So a short lease less than 50 years, taxed in the year it's received. So just at the very start, premium by 51, less the number of years leased by 50. That's important. You'll need to know that formula. And I don't think it's in the tax reference material. So there's our income. And then we take away the expenses. So mortgage interest is all allowable, but except for the pre-letting, and there's no 80% restriction. The 80% restriction just for residential. So it was purchased on the 1st of April. So from the 1st of April to December is 9 months in total. And of that 9 months, 5 months was let out and 4 months was the pre-letting. So 5/9 is allowable. So we just multiply the mortgage interest by 5/9. And then we take away estate and legal because they were mentioned as being allowable. And that works out our profit, and the 3 of them get added together. And then in the tax computation, you would say rental income or rental profits 22,183, and that will be added then to whatever other taxable income the individual has. Thanks.